you can actually put the September this time in a more positive context. As you were actually outlining as we got into the segment was that you see this catch-up now between the Dow versus the S&P versus the NASDAQ. That is that telling story that the industrial side of the economy is really starting to recover here. And we saw that yesterday in the PMI data. And so as we look forward to tomorrow, when the services PMI and ISM data comes out, really does show that too, that there will be accelerated strength coming through. So I think this is really what the September will be about. The economy is actually in a strengthening path and may accelerate in the fall.
The economy is on a strengthening path. It has been for a while now. We know that it's certainly better than it was during the March and April lows earlier this spring. Is it possible that there's economic data that could really derail the market? And if so, what would it be? I ask only because it's a big jobs report week this time around.
On the jobs front, that could be indeed a negative surprise. If we were to get on Friday report that's far lower than expected, and then the claims data starts to worsen because on, let's say, really the small business side, as I think where most of the unemployment stress is, further deteriorates because furloughed workers are not being brought back as permanent workers, then that will be, of course, a negative because it affects spending in the future. Other than that, it's really a function of also a global story that's recovering too. You know, data in both Asia and Europe, again, on the PMI side particularly, shows strength. So it's somewhat counter-setting. So I think you cannot really pinpoint to a particular data point that may be a catalyst for negative reaction in the market. More like, I would say, if the economy strengthens really more, like faster, then markets may be pricing in that in the future there could be, again, tightening of policy or no additional fiscal policy needed. That may be more of a catalyst if the market were to turn back down.
So let me just understand this right now. We have a lot of economic data that all points to this kind of this path higher for the U.S. economy, including the job side of things. There's higher frequency non-traditional data being kind of consumed as well that all points to that. Then what exactly would be something that you would look at that says, hey, the economy is not that solid, if not some of the traditional jobs data that we're looking at right now?
Well, there are two data points you have to keep in mind. Is that one is confidence. You know, consumer confidence has seen a click down, and that I think was notable. The conference board number the other day, because you know there is still very much of course, the stress on among people about the coronavirus and about the future of their jobs. So that's one important part. The other part is related to that is what we call the high frequency data in terms of the mobility and people being able to go around if the virus were to resurge. And for the moment, we're in a really good spot now. And most of the cases in states are going down and people are going out again. But if that reverses in the fall because of all the other influenza that comes together, with maybe the uncertainty around the election, then consumer confidence in particular is a key point to watch. I think the recent decline in consumer confidence was to be noted.
All right, before we let you go, just a few seconds, Ben, what's the best thing to do with your money right now, given that dynamic?
So I'm all about the reflation trade, as we call it now. You know, the Federal Reserve coming out with a new framework really sets in motion the idea of a reflationary strategy. That's actually a risk-on strategy in U.S. small mid-caps, Asia-Pacific and equities, as well as being in inflation-protected securities. Because if you have a policy geared towards the recovery of the economy and letting inflation running a little higher, you want to go with a reflationary strategy. So I think that's the way to go.